big welcome and thank you everyone for joining this live webinar. We haven't done one for a little while, so we had good feedback to do one of these this month, especially after last year and lots going on with Patriot Fund 5. We have a lot to talk about. Jeremiah will be leading the session. He'll be presenting a number of slides. The slide deck should run for about 25-30 minutes. I will be also accepting in the Q&A. So if you have a question, you can pose in the Q&A, and then I will manage the Q&A after the presentation. But again, thank you very much for joining. Should be a fun, entertaining, informative session. We have also in the panel, in case there's any specific questions, we have the leadership team. We have Sami Bakdash, our General Counsel. We have Chris Warfield, our CFO. We have Diane Cyr, who manages all operations as a COO from All Purpose Storage. We have Tim Wilkins, our COO here in Vegas, and myself as the Chief Investment Officer. So we have a full catering here of leadership. And Jeremiah will, as I say, lead the presentation, and I will run the Q&A after the presentation. Okay, with that in mind, we have a large number of people, so we should be set. Jer, can you take it from here?
Sure, guys. All right. Hey, so happy to have you. I know there's a lot of webinars out there, and I want to make this time as most useful as possible for you. So breaking it down, I want to educate everyone just on the opportunities around manufactured housing, communities, also self-storage facilities. These are considered alternative commercial real estate assets. And I've dedicated my life to learning this business. When I started out, I quit college, didn't know where I was going, what I was doing, but I knew I wanted to be in real estate, and I wanted a lot of passive income. And that was my focus, my dedication, and I was determined to figure it out. And why that was important to me is, one, I could see I come from a family of business owners. I'm from the Northeast, and I noticed that their businesses ran their life. And my grandfather was consumed with his business, but still never really successful. My dad, same thing, is just owned by his business. And then I saw all the opportunity that they missed out on because my grandfather didn't want to deal with managing real estate or didn't trust partners. And they could have bought apartment buildings and they would have appreciated times 10 all throughout southern New Hampshire. And it recognized to me that we have this opportunity where real estate is a long-term wealth generator, as we all know. There's amazing tax benefits, there's cash flow. And I was dedicated to, where do we find an edge? How do I find a niche? Because I didn't come from any money, and I figured out the hard way here, where can I actually create value rather than needing a lot of money to jump into this industry and then in turn achieve my goal, get passive income. And that led me to finding mobile home parks. So that was at the time I got into business back in 2006, 2007. And this was not a very attractive asset class. There wasn't a lot of institutional players, and it was really a mom and pop owned type industry. And then later I ended up finding self-storage, and it was the same type of industry. And looking through all the asset classes, I invested in retail, office, industrial, apartments, single family homes. I got crushed in the 2008 crash in Vegas. I was never going to make that mistake again. And I determined, these assets have an edge. They have a niche that we can really identify and then add value. And the reason being is because it's aged out businesses. It's where families have owned these for 30, 40, 50 years. They really aren't putting the time, the energy, the technology, the team, the customer service into these businesses. And we're a private equity firm. So as you guys know, I think you're aware, Patriot Holdings, we raise money and we pay our investors strong returns. And the way we do that is by acquiring these businesses and putting them into our vertically integrated system of managing. What does that mean? It just means we find the property. We go out there and build these relationships by boots on the ground, calling these family owners, meeting with them on site, building trust with them, evaluating the property, and then sending out an offer and coming up with a creative solution or win-win solution to buy. And then next, we manage the property. So we have a full in-house management team where we don't trust anyone else to manage the assets. We know how to do it best. And we provide good customer service for all our tenants. We make improvements on the asset. And we have a really dynamic call center. So we're very responsive to make sure people get their services or get their storage unit or their mobile home lot in the timely fashion. We have a construction department, and all these key leaders here, these are the people that I've brought in on the organization over the last 15 years, and they lead these departments. And what I've learned is a great idea is nothing. Every founder, every CEO, they can have a great idea. The team is what actually executes, and that's what I've been investing my time and energy on, and what everyone here is dedicated to. So to jump in right to what we're trying to accomplish here is, let's look at why mobile home parks and why self-storage is an opportunity compared to all these other real estate assets that are out there. Skip the slide there. This is the team. This is the key team, and you're welcome to connect with anyone here, and I'll share more about them later. So the real key is to identify opportunities before they actually hit the market. So that is really the core basis, is all of the flashy marketing, all of the nice ideas and strategies and philosophies are great, but unless you can find a great deal, you really don't have great returns. So first we'll look at, okay, well, what is a great mobile home park, or why are these really great opportunities? Well, like I mentioned, it's a fragmented asset class. So these buildings, these properties, the infrastructure, it's all been built 50, 40 years ago, and now these owners are aging out. It's a difficult business to manage, as you can imagine. There's a wide range of mobile home park quality properties. There's the lowest quality, where they're really dilapidated, very low income, drugs, crime. There's a lot of challenges in some of the mobile home parks. And on the other side, there's 5-star, beautiful retirement communities located in strategic real estate locations that have a lot of value. And we like to buy right in the middle. We're value add driven. So we buy 2, 3-star, sometimes 3.5-star parks, and we improve them. And that's what we're looking for here, is these opportunities where these owners don't want to put in an extra $500,000 and improve water lines, improve all of the roads, really deal with the tenants in the way that new tenants need they need a response. They need that quality customer service. And the key here is the affordable housing crisis. I mean, we all can agree that there is a real challenge in the country around how are we going to provide lower to middle income affordable housing. And that is exactly what this business does. And believe it or not, there is a large portion of the country that actually live in a mobile home park. It's bigger than you think. So we are providing that service, especially for rural communities around the country with blue collar jobs. The industry's evolved, right? It's turned. You think of a trailer park, and look in the corner here. That used to be what they were in the 50s, and now they are real quality homes. I mean, they have a 50+ year life, and they're truly not mobile. I mean, yes, you can move a home, but now with the cost of moving it, it could be $20,000, $30,000, and that's very prohibitive for our tenants. So we ensure when we buy a park, our goal is to keep adding these homes that are going to improve the quality of the asset and the tenant base. Next is the residents have a sense of community. This is really important. They have their own yard, their own driveway. In apartments, you just don't see that. We really notice that these people in our communities have been there for generations, and they want to continue to stay there, and we make sure that we provide a safe, clean, affordable environment for them to do that. And just to be clear, we don't typically own the mobile homes. So in mobile home park investing, the value is truly in a land lease community model. We own the land, and we own the entire piece of land. We don't sell off individual parcels. This is an example of one of our properties in New Hampshire. These are the different pad sites, and we rent out each lot individually for anywhere between a $400 to $700 fee per month. And they pay their own water, sewer, and electrical. So that's why this business has such high margins, because you're not fixing the home. You're not dealing with carpet and paint and roofs. It's a really, really profitable business if you own only the land and you have high quality tenants as your residents. And there's big players. So since I started out in the industry 15+ years ago, now we're seeing real players in the industry. You're seeing Warren Buffett. He owns like 100 and some odd portfolio companies. 3 of those companies are in the mobile home industry, and he has it all covered. He has the manufacturing of the homes. He has mobile home parks, and he has the financing of the mobile homes. He loves the industry. Blackstone, we all have heard of them, probably the biggest private equity firm in the entire world. They acquired a huge portfolio in 2021 of mobile home parks, and they are very bullish as an alternative asset in this asset class. And then the godfather of our industry, Sam Zell, if you haven't heard of him, he is the pioneer. He is the man that saw it all happening in the 80s and he built the first mobile home park public REIT and saw the value of the affordable housing, the strong real estate plays, and the high margins of these assets that you could scale. And then self-storage. So 10 years ago, I bought a mobile home park up in northern Nevada. It was from an older seller, that just the archetype that we talked about, World War II veteran. And then he was retiring, and he had a couple storage units in addition to his mobile home park. And at the time, my partners didn't want to be in the industry, so I bought my first self-storage facility and learned a lot of lessons. So self-storage is a very, very profitable business, but you can also make big mistakes. So in that property, learned the hard way how to identify markets that have good demand, how to price the units effectively, and how to make sure to make the right improvements and advertise. Mobile self-storage is highly, highly dependent on good marketing and advertising nowadays. And especially since COVID, people want easy access. So they want to be able to call on the phone or rent off a QR code very quickly. But why we like this asset class is because of, again, the aging owner base. It's a highly management intensive asset class, and that's why Diane is on our team here. She has led this, and she's taken extreme ownership, learning the industry and innovating in the industry over the last 10 years, where not only do we have amazing maintenance programs where we serve these units and make sure that they turn quickly so we can rent them to the next customer, but we have a really dynamic call center in the Philippines where we're renting units at a rapid pace, where a lot of other competitors are still counting on an older manager sitting in the office, wasting a lot of money on payroll, and really weakening the profitability of the property. And self-storage, if we look at it, I mean, remember, the first rule of investing with Warren Buffett is don't lose money. And then the second rule, he always says, well, don't forget rule number 1. So in real estate, we always focus on wealth preservation first. Don't lose money. So we looked at self-storage and mobile home parks as a hedge to make sure if there is a recession, if something happens in the economy where the markets collapse, these are the most durable, stable asset classes there is because they serve the masses. They serve lower and middle income population. So if you look at the recession in 2007 and 8 and how the other, how general real estate value took a dip, self-storage was very, very strong. It had a very, very small decrease in value. And then since this time over the last 10 years has bounced back significantly. So it's about asset protection first. Next, there's big players, real big players. These are now major public REITs that revolve around self-storage. And the industry has grown tremendously over the last 20 years. And it's still fragmented, though. There's still a lot of mom and pop small business owners where that is the blue ocean that we like to look at in order to add value and create passive income. I mean, that's what we're doing here and why we love the business. These are some of the big players in the industry, and we've worked with some of these players, and they are too big to go in and deal with a lot of these smaller assets. That's where the opportunity lies. They're not going to have a sales team go talk to an older owner in New Hampshire or down in central Illinois. Like, it's just not what they do. They focus on big portfolios and they acquire properties, but they're not going to do the dirty work to go in and turn around a lot of these value add assets that we acquire. And that is where the alpha is for us and our investors. And these are considered alternative assets. And this has been a trendy word over the last I don't know, 5 years or so, and a lot of wealth managers, RIAs, a lot of accredited investors like yourselves, they're looking at asset allocation and realizing that alternative assets are generating high yields and they're relatively safe, very safe, be in their portfolio. And that's why we focus on our funds only buy these types of assets. We're hyper focused. We're not bouncing around to a lot of different asset classes. And if
Sure.
we
Can
look
I
at a
just, few
yeah,
questions came in. I thought maybe it'd be a good time just to get those answered before we move to the session. Is that good?
yeah.
Cool. So one of the questions was, what asset class is more appealing, mobile home parks or self-storage, and why?
It's a great question. I think there's two prongs. So for long term, I would say for quicker value add, a mobile home park is going to give us that drive and value where we look for low rents, we have very sticky tenants, and acquiring mobile home parks allows us to raise the rents and increase profitability quickly. And of course, affordable housing is ideal. I think that is never going to go out of fashion. So mobile home parks are the choice asset class, yet overpaying and buying 50-year-old infrastructure or competing with investors that don't know what they're buying can be very dangerous. So there's been a slowdown in our acquisitions that's finally picking back up now. So mobile home parks are an ideal investment, yet to balance the portfolio, self-storage has its pros as well, where the profit margins are higher, where the expenses are much less. You have much less interaction with your tenants. And over the long haul, you can continue to drive value by expanding and raising prices on the asset. So for the short to midterm, I love mobile home parks. For a longer term hold, a 3 or 5 year hold, I like self-storage. So they fit both parts of the portfolio ideally.
Great. I think that answers the second question, which was about, high margins, but lots of work on mobile home parks. So that's probably a good answer to that. Third question is impact of big business. I'm thinking REITs, in this case, on the market. Can you talk to that, how you see that changing over time and in maybe recent months and years?
Yeah, the institutional players entering our asset class is an advantage because one, they're going to drive prices up, meaning they're going to drive values up. And we're ideally, if we choose to sell these assets, they're a potential buyer. And there's more available financing because now institutions are involved. And then secondly, there is an opportunity to acquire or the pricing to raise rents. So a lot of these institutions buy at a high cost basis and they're dynamically pricing the units to drive the rents as high as possible. So we like to use them as a competitor to discount their rents slightly and yet drive profitability in these markets where other mom and pops, they keep their rents low. They don't drive the rents, and competitively, it doesn't help us continue to raise value on our NOI because the rents are artificially lower. Was there a question on mobile home? And mobile home parks, institutional players in that area, I want to address that too, is an advantage for us as well because for the same reasons. Is now when I started out in the industry, I would buy a park, I'd add value, I had a handful of partners, and then we were subject to selling to a local buyer, and we had to sell them at typically higher cap rates. And we've seen cap rates continue to compress because of these private equity firms or these larger private REITs that are coming in and buying the assets. So for us, yeah, it's competitive, but it's going to help our investors actually create more value over time so we can get that exit.
Okay, great. Third question, maybe Diane can answer this one. It's about typical customer or tenant in a storage property. So perhaps maybe the context there is anything changing? What's the typical type of tenant? Diane, maybe you can come off mute and.
Hey guys. Yeah, we have a we have a lot of different markets, so that the typical tenant would be different based on the markets. So some markets that are more demographically prolific will have more businesses storing there because in those markets the land is more expensive, rentals are more expensive, so we'll see businesses using the storage. In more downtrodden areas, you're having a really low income tenant, and those are actually some of our favorites. They pay the highest rates. We do have higher delinquencies there, but always people looking for storage in those areas. So it's very dependent on which market.
Okay. I would like maybe while you're still on as well, Diane, just a question on marketing has been a big thing in storage, maybe progressively so in recent times. Do you want to talk to that more competitive market in marketing?
So there's been a softening from the huge boom of COVID. So in COVID, everyone was leaving the cities and storage was growing at a much faster rate than normal. And now we're seeing it come back to pre-COVID growth levels. So that slowing is just coming back to a more normal rate. And as we move in this, what we're considering a softening market, there's been a lot of supply coming in. So we have actually not felt the softening. And maybe these last 4 months, we've had a kind of flattening through the winter, and we're just starting to come out of that now as we had March is the beginning of our spring season up in New England. So we're just kind of coming back out of that flattening for the last 4 months. But across industry, there's been like this softening over the past year and a half, 2 years. And we did not feel that effect because of the marketing that we did, but we had to pay for it, right? So we combated the slowdown by getting more percentage of the market by increasing our marketing. So it's definitely a game to play. It depends on, again, the markets. Each market is a little bit different. Some markets, we own the whole market, so we don't have to advertise much because we're all there is. In other markets where we have a REIT competitor, we have to play the games with the REITs and we have to pay for the marketing.
Good job. Thank you. All right, Jared, back to you.
Yeah, so comparing real estate to some of the other asset classes, the traditional market in the S&P 500 or a CD or money market, I mean, obviously we outperform any type of fixed income product like a CD. Yet we're in the value add right here, the value add and opportunistic market. And so when you look at it, yeah, we're very comparable to the stock market. I think the real key, though, is the tax advantages. And the stability along the way. So there's heavy tax advantages with real estate investments, and our partners in our funds, they receive those tax advantages. We can get into that later in the presentation, but we accelerate losses through depreciation, and then we let those or flow those losses down into the limited partners. And it's a big advantage over a 5-year fund. You're effectively deferring any of the distributions that you get each year until paying tax until we exit out of the fund. And that compounding effect over time affects the returns dramatically. And it's been a huge aspect of my investment philosophy and many of our investors' philosophy when making a decision on where to invest in their asset allocation. And then we love the hedge against inflation. I don't know if you guys have seen the stated inflation in 2022 was 8%, but the mid-8s, and that, as we know, doesn't account for energy, housing, some of the critical drivers of the cost of actually living in a society. So inflation was through the roof, and that's what self-storage, what Diane was referring to, is during the COVID pandemic timeframe, that we were able to outpace inflation and raise our rents, and we are on month-to-month rents, and that's one of the areas that we really like about self-storage and manufactured housing. We're on annual rent increases there as well. So we're not into any long-term fixed rental agreements, and we can incrementally raise the rents as inflation continues to drive up prices in our economy. And yeah, this was that chart around inflation. And if you're in the traditional market, if you didn't receive an 8% return in 2022, you effectively lost money due to the purchasing power of inflation. And this is exactly what I was sharing here, just these malleable rents. And this is a very, very big point with institutional players. This is why they really like this asset class, in addition to it being sticky with our tenants, is that they can adapt quickly as the market shifts. And we love having the collateral. I mean, people don't want to throw away their stuff, and we have their stuff. So it is a nice feature here. And we like to joke around that storage is like the Amazon SaaS model of real estate, where someone rents online, puts their stuff in a unit, and then we get their credit card information, and they don't come back. And we just continue to recharge their credit card each month. I've had a storage unit throughout college. I've had it throughout my 20s and 30s, and I recently got one because of so much stuff. And I just look at that bill, but it's not painful enough to actually get rid of the stuff. So I just let it keep ticking away on the card. And that is the fundamental aspect of our business. So God bless Amazon, and people keep consuming in America. And storage demand seems to spike during recessions. This is interesting concept. It's a inverse relationship where when the economy collapses, people consolidate. So they actually start to move into smaller spaces, shared living spaces, and preserve and hold on to what they have. And it drives actual demand because people can't afford to actually live in a place that they have enough rooms for their goods. And we saw this with the COVID effect too, where people were working at home. Kids were taking school at home. They were working out at home and having hobbies and projects at home, and they're running out of rooms at home. And that continues to drive the demand here as our society shifts from that work-home dynamic. So what's different, right? There's a lot of storage companies out there, a lot of mobile home park companies. What truly makes us different here? And we ensure alignment with our investors. That's number one, is we put our money where our mouth is. Our team here invests at least $1 million in each of our funds. I always have a saying that you're betting on the jockey and not the horse. And us as the jockey, we make sure that we are committed on the horse because our own money is up with our own investors. And also my credit and my balance sheet is on the line because in order to get the advantageous financing for these deals to really drive value, we work with local and community banks that understand the asset classes, and they will give us favorable interest rates and loans. And then I personally guarantee those loans, ensuring that we get the best rate possible so we can drive returns.
Hey, Joe, a
Yeah.
couple of questions there. So one, just going back, please clearly explain cap rates and how adding $1 of net income, either by reducing costs or increasing rents, adds value. Yeah, and there's a bit more here as well. If you can answer that first.
Yeah. So the nice thing about storage and mobile home parks is we have a relatively fixed overhead cost. So we have our taxes, insurance, management, maintenance, utilities, and general admin. So those costs really don't vary much. So the fact that every time we drive revenue on the top line, our expense ratio gets smaller, right? Because that portion of the revenue is less. So then that drives more NOI. And then obviously the more NOI, right, at a 6 cap or anywhere. Right now, storage is trading anywhere from a 5.5 to high 6 cap, and same with mobile home parks, maybe a 7 cap in some markets. You could do the math. Is that dollar of NOI that you create at a 6 cap or at a 5 cap is 2 times there, 20 times. Is it? Yeah, 20 times
20
of what?
Yeah.
Yeah, that is. So you can imagine how much every dollar of NOI drives the value of the asset. So it's really important that we maximize occupancy, maximize revenue, because that's going to give us the lowest fixed cost. So I hope that helps when talking about NOI and cap rate.
And yeah, just a follow on to that, you talked a little bit about month-to-month rents. I know Diane is all over dynamic pricing. Either you or Diane want to comment about, what's that game to be played? How do you manage rent increases over time?
I mean, Diane does it, and it's the Expedia model. When we met with some of the major public REITs and looked at their systems, dynamic pricing is everything, right? And when we were looking at how the hospitality industry worked 10 to 20 years ago, it's demand pricing. So if the question is, how do we do that? Then, this is what Diane's been focused on over the last 3-4 years. But in terms of the strategy, it is per unit pricing. If you have a limited amount of units and you have a high demand, we are going to drive the rents as high as possible on that unit type. And then in other units, even at that same asset, we will lower the rents and offer concessions on those units to get people in the door and fill occupancy. And then the real strategy across the entire industry is month 5 in month 9 driving those rent increases. So you're boiling the frog, right? You get them in there, and then you just get it up enough where it's not going to cause them to leave, but then you're maximizing revenue on those units that didn't have as much demand 5 to 9 months earlier.
Question that went back to mobile home parks here. Can you just own the land and not the home in all 50 states, or is it state specific?
No, yeah, there's a land lease model everywhere. We are seeing, and we're very on top of the legislation around rent control and around there's a tenant-owned community initiative in some states where you have to offer the entire mobile home park to the tenants to buy under a co-op before you sell it to a third party. So sometimes we've missed out on opportunities where the tenants have grouped together and gotten state financing and bought the mobile home community before we were able to acquire it. So that's, but in terms of, there's no legislation that you have to own any of the mobile homes. It's an advantage for the resident to own and pay off their home because they have a very affordable rent. It's about 1/3 to 40% of what an apartment would cost as long as they own the home themselves.
Okay. One other question, you mentioned tax efficient investing in one of the previous slides. There's been talk about changes in bonus depreciation. I don't know, Chris, if you wanted to talk about that and what your feelings are about that coming forward.
Yeah, happy to do so. So currently, bonus depreciation is in a phase-out period, whereas the Tax Cuts and Jobs Act of 2017 had bumped bonus depreciation up to 100%. That allowed us to maximize these pass-through losses that Jeremiah was mentioning that we pass through onto our investors. Currently, for the current year, it's set at 40% of 5 and 15-year property, and set to phase out to 20% next year and 0% in 27. However, the advantage of having a Republican administration is that this legislation is back on the table to be increased up to 100% again, and it's currently sitting on the desk in the Senate, and they are in the process of going through their rounds of voting on it. And assuming that passes and makes it to the president's desk, the expectation is that it would be signed into law, and for the 25 tax year, we'd be back to 100% bonus depreciation. And why that's powerful is because under current legislation, as it sits at 40%, we're really only able to pass through about 40 to 50 cents on the dollar in losses. At 100% bonus depreciation, that number skyrockets up to 100 to 120% on the dollar passed through to the investor in passive losses.
Got it. Thank you. Okay, Jer.
Yeah, and we'll do a webinar in the future about the power of the tax advantages around real estate investments. We'll focus on passive losses, active losses, the difference between the two, and we'll go deep into some other strategies around 1031, retirement account investing. It'll be fun if you like taxes. All right, in terms of our Patriot track record, this is what we pride ourselves on. We're on our 5th fund today. So if everybody, we'll get into the funds or the structure of the funds, but we essentially pool together everyone's money, including our own, go out and acquire these assets, add the value, and then sell them within 5 to 7 years, and then pay. We'll go through the returns, but we've achieved over a 20% return on our first fund we're closing out right now. We're achieving a 22.5% return to our investors. And in our previous partnerships, we've achieved over 20%, bought in well more than hundreds of millions of dollars of real estate, and now in the industry 20 years. And I think a key thing as a passive investor, where I've invested in other real estate projects myself, and even the reporting is very important to me, leading the company and seeing transparency of how are the financials, how are the assets performing. What are our goals for the assets, or where are we at in relation to the business plan, and when can we anticipate an exit so we can prepare for those tax events? And we've really focused on this over the last 3 years, building in an internal reporting system. We'll get into, we provide a portal for our investors to look at their investor statement and highlighting any challenges and wins that come along the way. And I highly suggest if people are looking to go out and do this themselves, it's a profitable industry. It's just quite competitive. I think that some of the challenges here, there's financing is difficult to get if you don't have a track record. Finding deals is the hardest part. It's very competitive with firms like mine that are out there scouting every day. We have a sales team of 5 guys. We have 2 setters. We have that are actually in South Africa. They're doing research. They're finding people. We're calling people, and we're building these relationships that take time. It took over a decade to create a really solid database and a reputation for us to be able to get opportunities before they hit the market. So that was a big lesson for me, and not something I suggest jumping into if you're not willing to go out there and scout and hunt and find the deals. Plus due diligence, there's a tremendous amount of mistakes you can make, which is not a bad thing. It's a learning curve, yet the infrastructure is critical to evaluate because it can be an unforeseen cost that can truly diminish returns. And we're looking at any mobile home park investment partnership. If that is not handled, then that could be the thing that kills cash flow moving forward. Because on the inside, I'll tell you what, inside investing on mobile home parks, this is something that doesn't get shared a lot. And when the market's hot, investors will go find a good mobile home park. They'll raise the rents. They'll put lipstick on the pig, and then they'll sell it. But they're dumping it because underneath there is a rotting infrastructure and or tremendous tenant challenges that they're pawning it off to the next guy. And the real hard part of the industry is actually managing it day to day, having a sustainable system, and making those long-term capital improvements where the actual community is going to be valuable and profitable for decades. That's the difference that makes the difference in the industry, and most people don't talk about that. And that's why I talk about operations and scaling, as you're dealing with people and you're dealing with an interesting demographic across all parts. and anybody that's in multifamily or residential housing, you're dealing with someone's home. You're dealing with the elderly. You're dealing with low income. You're dealing with just people in general. And they have wants, demands, needs. And we really try to align ourselves where we're fair, but we're very firm. We enforce the rules, and we give back. We did a Christmas tree drive where prided Christmas trees to a lot of our residents. We gave them a gift card for Thanksgiving. We want them to know that we care, and that's really important to us. At the same time, we will not be pushed over, because if you give them an inch, they can take a mile. And it's very important that we enforce these rules, and that's what keeps a quality community for all the other residents. And they thank us after we enforce these rules. So why we provide the funds is because of these reasons. Is a lot of people came to me that I had in my network learning real estate and understanding commercial real estate investments. I transitioned from residential to traditional commercial, tried some retail deals, office deals, apartments, could not find a way to continue to get value that I could grow quickly, and got into these asset class niches, and other people were interested in wanting to get into storage and get into mobile home parks. And that's why we handle it all. We find the deal, we manage the deal, and we distribute and report on that deal, keeping our investors up to speed. So some of the projects that we acquire, they are value add. We're not going to buy an asset that is already highly improved. We like the old deferred maintenance. We like the older, ugly facilities. It doesn't look like a lot, but we improve it by paving it, by painting it. We put in good lighting. We put fencing. We put cameras. We put good management in place. These are all the things that create millions over and over, multi-million dollars of value on assets, by getting in there and turning these dials that take a year, 2 years, 3 years to turn around. You know, it's not sexy. This is not a very good-looking asset, but it provides a good service. And as you can see, there's very little maintenance. After you do the improvements on the paving, the doors, the painting, the roofs, they're pretty indestructible. And why we act now, why we feel it's a good buying opportunity out in the market right now, is we've seen a lot of players fall away, because right now you're not able to raise rents like you could during COVID. So there is not a lot of quick wins right now. You can buy and sell and make $500,000 or $1 million on an asset. You got to be in it for the long haul. And that's why we like this business. And that's why we like the opportunity where these players are not playing. I mean, it's a heavy cost across my organization to make sure that all of our team is in place to execute. And if these other players don't have the team to do everything that it takes to be successful in these asset classes, they have to stop their acquisitions and they have to go find something else. And we've seen that. And we're seeing sellers also start to have some of their loans come due, where these lower interest rates no longer in place, or there is so much deferred maintenance that they realize that they don't want to put more debt on the asset. They want to sell it and get out, or they don't want to manage. Like I've said, that is the best aspect of these asset classes. It's hard to find a good triple net McDonald's hard corner investment because there's no management. An investor buys that lease and you have it for 30 plus years. And why would anyone discount that? But with our assets, people are ready to sell. They're ready to get out of the business. And some of those people have actually reinvested with us because they see the value of how we turn around the facilities and they love the asset class. And this is exactly what I'm sharing here. Just getting teed up with the slides. These owners do not hold these forever. So let's dive into the opportunity. Here's the fund. This is our 5th fund. We're closing out our first fund in the 2nd quarter of this year, and we will be achieving that 20+% return to our investors. So it's a accredited investor fund, which everybody knows on here. You all are accredited investors. We are right now raising $25 million, and here is what the investor returns are. They get an 8% preferred return. So we allocate and call the money immediately. So as soon as we get an investment in, right now we have about $28 million in our pipeline of acquisitions. We have 2 mobile home parks and 4 or 5 storage facilities, and we have 2 more mobile home parks on the horizon. So deal flow has picked up a lot. Compared to last year, we did less than $7.5 million in acquisitions. That was only 3 transactions, and they were all in the 4th quarter. So we were very disciplined last year in not going out and buying assets in a down market. And we've seen that turn where now we can actually achieve cash flow year 1 on most of these assets. And that's why we're paying the 8% preferred return to the investor. It accrues immediately. So as soon as you make the investment, that 8% starts to accrue on that capital balance, so the amount invested. And then as soon as cash flow comes in, it starts to draw down that 8% preferred return. And then 100% of the depreciation go to the investors. So like Chris was saying, whatever passive loss we have will go back to the investor as a way to offset their passive income. And then our equity multiples, we target over 2 times the money being paid back to the investor over a 5-year life. Our funds are 5 years. And our average returns right now, we're being very conservative as a 16 to 19% average return. Here are the assets that we have lined up in the fund right now. And as you can see, we're picking off, they're smaller assets. They're in that $1 to $5 million range, and they total cost basis anywhere after we make improvements in that $2 to $5.5 million range. And what I mean by cost basis is all the improvements that we add on to the asset obviously increase the cost. And if you see here, our first yield on cost is low. Some of these assets are in the 3%, which is essentially the cap rate, which isn't great. But the key is that we're not aggressively doing anything to increase value. We're just raising the rents to the market, and we're doing the improvements that are needed that are relatively simple. The paving, painting, lighting, fencing, and making sure that the mobile home communities are cleaned up. And that's what's getting our yield on cost. This is where we want to be. In this 9 to 10 range gives us a really good yield because we're borrowing at less than 7%. And that's where the cash flow and the investor returns are coming from.
Jared, quick question here. Why exit after 3 or 5 years rather than retain and allow compounding returns to generate?
Well, I love that question because I don't want to exit anymore, because you guys want your money back, and that's why. So most investors were wanting that buy, distribute, cash flow, and then sell But we haven't created the fund structure yet. But my goal in the next 2 years is to create an evergreen fund where we would have the ability to assess the value of the asset, look at the long-term potential, and then potentially roll that asset into a long-term fund at the competitive fair market value. And the investor would have the right to put that, to reinvest in that evergreen model where we wouldn't have a close date. We would hold the assets for 10 to 20 plus years. We don't have that structure in place. It's a bit of a different fundraising structure, but one that I will put in place in the next few years, because I'm noticing that these assets, and this is one of the reasons why we are aggressively buying, is once these assets are sold to private equity, to a public company, they're off the table. Those guys don't sell at discounts in the future. And these assets are getting harder and harder to buy, harder to build. And we want to retain these assets and provide a long-term legacy wealth vehicle for our investors and ourselves.
Do you want to just explain the yield on cost after 5 years? There was a couple of questions about that.
Yeah. I've been making YouTube videos on this too. So if you guys check out my YouTube channel, I do a whole thing on it. But this is a metric that a lot of institutional investors use. So this is the lingo that we talk, and it's just a fancy way of saying this is the cap rate on the asset after you've added in all the additional costs of improving the asset. So you have your purchase price plus all the capital improvements, all the physical improvements you made, and then any closing costs or fees that were charged. That's the total cost basis of the asset. And then you have the NOI that's generated from the asset at that time after rent increases and stabilizing and filling the park or the storage up on occupancy. And this is the yield. So this is your effective cap rate at that time. So these are very conservative rent increases, very conservative on the occupancy increases. So over that time, we're taking these assets from a 3.8, 4, 6 cap and getting them to a 9 to 10 cap. Mm-hmm. That's what that means. I hope that's clear to everybody.
Yeah, it's not the market cap rate at the exit. It's the yield on the actual asset that we own.
I'm glad you bring that up, Shane. Yeah, so not to be confusing. Yeah, we do not sell at this price. If cap rates go to 10, we're definitely not selling. We're going to keep distributing cash flow to you, and we're going to go raise more money and buy a lot. But the challenge is in the interest rates. So, right, the yield, typically cap rates, as everyone knows here, are dictated or influenced heavily by the interest rate. So right now we're borrowing in that high 6, at best mid 6, and on really challenging assets in the 7s. So cap rates are hovering right around that range. So in 5 years, if cap rates are anywhere around that 6 range, yeah, we have a huge delta between the difference. So we would be selling in a 6 to 6.5, 7 cap. We're projecting a 7 cap range, but that is the exit cap. This is the actual cap rate that the asset is generating on its own.
Right. Okay, let's keep moving.
So this is a simple diagram about how a fund works. A fund is the equity is pooled together. We raised the $25 million. We go deploy roughly $23 million out of that. And then we have a couple $1 million of reserves and of improvements for our capital improvements. And then we go out, buy the high quality assets. We try to acquire $50 to $60 million of real estate. Typically, we'll buy 10 to 15 assets, depending on the size. We'll probably get closer, since they're smaller, to 15 or 20 assets. And then all of the cash flow flows back into the fund. And then the fund distributes and pays the LPs their 8% preferred return and the 70% of the profit shares after that 8% is paid. And before we pay the 70% of profit sharing, the investor's capital is paid back as well. So that is just a simple way of how a fund works. So every asset has to check the boxes. Has to have stable, consistent revenue. Just so everyone knows out there, we're not buying an empty Kmart that we have to convert and then go find tenants and fill it up. That is not the play anymore. Sufficient scale, that we can't buy tiny assets with 50 units or just 100 units. We may have some assets that are smaller, but typically we're aggregating them and adding them to other properties that are around us. So we want at least 300 units, and on mobile home parks, we want at least 80 units. That gives us enough of a gross profit or a gross income to drive enough profit to the fund that our investors will be satisfied with the returns. Value add, just like I said, we're not buying something that is already perfectly stabilized. There's nothing to add in value there. We need to find the mismanaged opportunities and the mismanaged markets. Favorable debt. So just so everybody's clear, like, we have fixed debt. Every asset in the fund has a fixed interest rate for at least 5 years. So we're not getting any variable debt where if interest rates go up, that's going to affect your investment. And also, we have typically an interest-only period the first year. We negotiate this with the bank, so it helps with year one cash flow, and it helps us reach our debt coverage when we're buying some assets that have a lower revenue out of the gate because of the mismanagement. We negotiate the interest only, and that helps us stabilize the asset, reducing the cost of our debt the first year. And like I said, there's recourse loans on me, and that gives the lender additional comfort to give us these very competitive rates. And we went through this. We only go in markets that have low supply. So mobile home parks, we're not seeing many of them. There are no new mobile home parks supplied out there. In terms of storage, we like markets that are very challenging to get into. A lot of opposition by politically in the market to zone them, or by the residents where they don't want more of them, or the land is not conducive to build more of them with the zoning or the topography. And then with mobile home parks is we acquire these assets where affordable housing is needed and no new supply will be created. No one's building them at scale whatsoever. And then obviously we want a good deal, just like everyone out there. That's why we hit the phones. That's why we're sending letters. That's why we text. That's why we get in touch with these people. It's not like we're taking advantage of anyone. It's the fact that they have, like you saw in there, we're buying at 3, 4, 5% cap rates, which is obviously not competitive, yet there's so much latent value, so much hidden value in the asset that we can unlock it immediately with our team. And we're buying at a low cost basis, well below replacement cost, $60, $70, $80 a square foot, where there's no way you can buy land and build anything close to that in any of these markets. And on the mobile home park side, $20,000, $30,000, $35,000 a pad, you're at $80,000 or more to build a pad. So we love buying well below replacement cost. And I know we're pushing up on the hour here. I think I would like probably, Shayne, in the future to do something where it's a modeling exercise where we can create a video or we can have a webinar around all the real estate, the nerds and analyst freaks. We love it, but it is quite boring to go through this model. But we can go systematically through every input, every assumption, what we've learned over the years, and we're happy to provide the model, some of our models for you guys to dig into the nitty gritty. But I don't want to lose everyone here doing that.
Yep.
And this is the last thing to wrap it up. I think this is an interesting philosophy or metaphor, right? It's an old Wall Street saying, you bet on the jockey, not the horse. And I've been in this 20 years now. It took me almost 10 years to raise my first investment dollar, and I'm glad it took so much time because I could make a lot of mistakes and learn from those mistakes. And essentially what it means is that whoever you are going to be working with, if it's a partner, if it's a fund manager like us, if it's just someone that's doing a casual real estate project that you want to invest in. Number one, the first question to ask anybody is, does the partnership or funds have a clear strategy? Right? If they can't explain it, then they can't build it. And that's a problem. And I've been in deals where it was very complicated around what are we really doing here? And I don't want to get into those, but this is a very simple business that we do. We provide affordable housing to people, and we provide safe, clean, affordable storage for people that don't have any space. It's a basic business. It's not complicated. How much skin do you have in the game? That is the question to ask the jockey or the person raising money. I personally have $1 million in every single fund. And I think it's very important because I've invested in other private equity firms where the person actually generating the investment doesn't have a lot of their wealth in it. And when things get hard, it's easy to walk away. So it's nothing wrong with asking that question. Is the sponsor in other projects? No, this is something to ask. If you're working on 5 different asset classes, and I've seen sponsors do this, where they're buying a retail center, they're buying an office building, they're buying an apartment complex. I don't know how they do it, and I haven't seen consistent long-term returns. And I've made this mistake early on in my career. We only invest with our fund, and we are investing in these assets right here. I mean, I have a handful of projects that I own personally, but our fund is what's buying these projects, and we allocate all our deals to the fund. We don't cherry pick great deals. These are fund deals that we provide, and this is the only asset classes that we focus on, and the ones that we've earned. We learned that we are great at these assets alone. History of transparency and challenges. So what I like to say is ask someone who's raising money about their failures, and then listen to the response. Because the first thing to listen to is if they say they haven't had any failures, then they haven't been battle tested. Because if you're an entrepreneur, business owner, or investor, everyone has had failures, period. And then secondly, ask them about if they don't share them and they're not willing to disclose them, there's no transparency. I've invested in other private equity deals where I made an investment, 2 years have gone by, I didn't know what happened, and then I lost my investment. And I was very frustrated by that. I would have liked to know along the way what happened or what's going on. Even if there's bad news, it's better than no news. So we pride ourselves on quarterly reporting, sharing the performance, everything's not going to always go to plan, but having the character, the integrity to stand up and address these problems and share how we're going to solve them is what great CEOs and great companies do. And then who's the team? Like, no longer do I invest in a founder or someone that has a great idea or even controls just a great deal. It's all about the execution, right? So that's why I invested so much in this team with me here, and they were all vested owners of the funds. And that's really important because they're sacrificing their paycheck and their salary in order for the long-term success, to achieve long-term success in the fund. And they sit on the ownership table with myself. And that's why our interests are aligned, and they take pride in what they do. And then is the jockey willing to die on the horse, right? I'm not a traditional CEO that's just going to paint a pretty picture and show everyone institutional graphs and metrics. When things go wrong, I'll do whatever it takes. And I've done it again and again and again. And I've made mistakes. But at the same time, I stand behind all my investors. No one's lost money in any of the projects that I've done for 20 years. I've sacrificed personally, and I've made sure that everybody, no matter what happens, we work out a creative solution that they're going to get their investment and get a return. So that is the true commitment of this game. And I've learned in traditional private equity, people lose your money and they say, oh, we're big boys, that's how the game goes. And it's not how the game goes here. We look at everyone like a partner, and we put pride and a lot of ownership on taking on the responsibility of bringing on investors' money. So I really appreciate the time. It's right at an hour, and I'm glad that we could educate you guys on these asset classes. If you need more information, please reach out to us at Patriot Holdings and schedule a call. Shayne, myself, we would love to talk to you in person and walk you through more nuances of what we do and why we believe we're in the right place at the right time.
Great stuff. Perfect timing. Thank you, everyone, for attending. There is a disclaimer also. I think, Jeannie, you're going to share that on screen. So obviously a disclaimer that we will have in the deck of slides that we will send out to those that could not make it but registered. And appreciate all the questions and the presentation from the team here. Thanks for taking the questions. And let's keep going. Reach out to us. We'd love to hear from you. Thanks, everyone.
Thanks, guys.